Hello, today I'm joined by Guy Anderson from the Mercantile Investment Trust. Guy invests in UK stocks, including retailers and house builders. So Guy, one of your biggest holdings is Watches of Switzerland, which has been growing sales at quite some rate. However, its share price has been stuck in the mud for ages. What's the market worried about? And do you actually think that investors are jumping to the wrong conclusions about the company?
I think the question on most investors' mind is all around the sustainability of the growth, because as you've said, its growth has been stellar. So over the last 3 years, sales have nearly doubled. So it's been growing at a mid-20s annual growth rate. And of course, when something is growing at such a high rate, the market or investors want to understand whether that can continue or whether that growth is going to fade quite aggressively. And to be fair, they have given guidance for this year, which is for that growth to moderate to around the 10% level, ballpark. So some slowdown in that growth because of consumers potentially getting a little bit weaker. So it is a valid concern that the market should have. But behind that, we have to consider the fact that they're still only touching the surface when it comes to their market share in North America, which is the huge growth opportunity that they're only just beginning to grapple. And so we actually think the long-term growth rate has the potential to accelerate from this year forwards. Another
one of your key holdings is Bellway. Now, house builders have had a pretty terrible time on the UK stock market over the last year. Investors are worried about a downturn in the property space. What would it actually take for shares in this sector to bounce back?
So that I find the house building sector, it's almost a sort of turbocharged play on the sentiment towards the domestic economy. But also, of course, intertwined within that is the outlook for interest rates. And at the moment, they've really had the double whammy going against them of, as you said, sentiment to the domestic consumer really falling through the floor, big concerns about potential house price moves, in part, of course, caused by very sharp monetary tightening. The interesting thing, I think, from here is that monetary tightening is presumably most of the way complete at this point. So a lot of that headwind has worked its way through, whilst it hasn't necessarily fed through to the consumer yet. It's there on the sticker price, if you will. But also, house prices and consumer spending have both been very resilient so far, which means the risk of a severe fall in house prices, I think, has to be far lower today than it was 6 or 7 months ago. And so for me, that means the outlook for the house builders themselves is far improved. The risk that they'll have to take impairments to their NAV, to their asset value, is far lower. And yet we're still at very attractive starting valuation, in most cases trading below their book value. So I think actually the outlook from here is really quite exciting.
Now, cost inflation must still be a problem for house builders, and there isn't really much signs of that easing off. What's your sort of view on what's happening there?
Yeah, cost inflation has been a big challenge. I think we're going to see the early signs this year of that cost inflation moderating, particularly, of course, on the materials side. We're already beginning to see that start to come through. I expect we'll then subsequently begin to feel it on the labour side as the cost inflation comes off. But yes, the margin profile has been under a bit of pressure. But again, it comes back to that starting valuation being so low. Of course, the tax burden on house builders has also increased quite substantially. So it would be wrong to look back to what in the rearview mirror maybe feels like the sort of halcyon days of the mid 2010s, sort of 2014, 2015, where we had a lot of support and very high profitability. But even without replicating that, I think from where we are today, the outlook should be pretty good.
So Guy Anderson from Mercantile Investment Trust, thank you very much for joining us. Thanks for watching.